Walk into any bank with $50 in your account and walk into the same bank with $25 million in your account, and you will not experience the same institution. Same logo, same lobby, completely different bank. Banks don't treat customers equally. They're not designed to. They're designed to allocate attention, patience, credit, and opportunity in direct proportion to how much money you bring them. And almost nobody ever sees the full staircase because most people only ever stand on one or two steps of it in their entire life. Today, we're walking the whole staircase. 12 levels, $0 to $25 million. Every fee, every perk, every quiet double standard hiding in plain sight. Stay until the end, because the top of this staircase looks nothing like what you'd expect, and neither does the bottom. At $0, you're not really a customer. You're a liability the bank hasn't decided how to handle yet. Opening an account with no money and a thin credit history often means limited options from the start. Some banks require a minimum opening deposit you may not have. Others run you through a screening database that flags past account mismanagement, even minor, years-old issues, and can block you from opening a new account anywhere for a while. If you do get approved, overdraft fees are not a rare inconvenience here. They're a structural risk. A $4 coffee, timed wrong, can become a $39 mistake, and that $39 mistake can trigger a second fee if the account stays negative, and a third. It's not uncommon for someone at this level to pay more in fees over a year than they'd ever earn in interest in a decade. Customer service at this level is a phone tree, not a person. Hold times stretch. When you do reach someone, they're polite, professional, and moving to the next caller as quickly as possible, not out of malice, but because the entire system is optimized around accounts that generate meaningful revenue, and a $0 balance generates almost none. This is the level where financial products aren't offered to you. You have to go find them yourself, read the fine print yourself, and hope you didn't miss a fee buried on page 14 of a document nobody actually reads. A few $100s doesn't buy you much goodwill, but it does buy you visibility to the bank's fee structure in a very real way. This is often the range where monthly maintenance fees start quietly eating into balances. $12 here, $15 there, unless very specific conditions are met, like a minimum balance or a set number of direct deposits. Miss the threshold by a few dollars, and the fee hits anyway. At this level, a huge percentage of the bank's messaging toward you is fee avoidance messaging, dressed up as helpful notifications. You're close to your minimum balance. Enroll in overdraft protection. Consider our fee-free checking option, which usually comes with its own trade-offs, like lower functionality or no physical checks. The emotional experience here is watching your balance in real time, because a single missed paycheck deposit or a slightly too early bill payment can trigger a cascade of fees that takes days to sort out and calls that go nowhere fast. A few $1,000s in the bank changes almost nothing about how you're treated, but it changes how you experience your own anxiety about the relationship. You're no longer at immediate risk of an account closure for insufficient funds, but you're still firmly in mass market territory. Standard checking, a starter savings account with an interest rate so low it's almost symbolic, often a fraction of a percent, while inflation quietly erodes the value of every dollar sitting there. If you call customer service, you'll likely reach a general queue, not a dedicated representative. If you walk into a branch, you'll be greeted the same way as everyone else that day: pleasant, procedural, generic. You might get pre-approved credit card offers in the mail, but the actual approval process treats you like any other applicant off the street. This is the level where a lot of people first start comparison shopping between banks, discovering that the relationship they thought they had was really just a shared login page and a customer number. Somewhere in this range, the bank starts to notice you exist as more than a line in a database. You may start qualifying for better credit card offers, small personal loans at more reasonable rates, or an invitation to open a CD or money market account with a marginally better yield than standard savings. Some banks will flag your account for lightweight financial wellness outreach, an email or app notification suggesting you talk to someone about your goals. But the attention here is automated, not personal. It's triggered by an algorithm noticing your balance crossed a threshold, not a human being who knows your name or your situation. You're a segment now, Not an individual, a slightly more profitable category to market to, but still largely anonymous in practice. This is also the range where auto loans and mortgage pre-approvals become genuinely accessible for the first time, assuming your credit history supports it a meaningful shift from the previous level, where those products often felt out of reach even to inquire about. This is often the first level where banks proactively offer you something instead of waiting for you to ask. Many banks have tiered checking and savings programs that unlock around this range, fee waivers across the board, slightly better interest rates on savings, occasional perks like free checks, discounted safe deposit boxes, or waived wire transfer fees. You might get invited into a preferred banking program, which sounds exclusive and, relative to what came before, meaningfully, is even if it's still a modest tier in the bank's overall hierarchy. Customer service starts to feel less anonymous here. You might have a designated branch banker who recognizes your name, though not necessarily your face, especially at larger institutions. Loan approvals get easier and faster. Credit limits creep upward without you asking. For the first time, you start to feel like the bank wants your business, rather than simply tolerating your account's existence. This is also the point where mortgage rate discounts of a fraction of a percentage point sometimes appear small on paper, but worth thousands of dollars over the life of a loan. Six figures is where most major banks formally shift you into a wealth-adjacent tier, sometimes called priority, premier, or relationship banking, depending on the institution. At this level, you often get a named point of contact, not a call center agent working from a script, but an actual banker whose job partially involves managing relationships like yours specifically. Response times shrink dramatically. Fee waivers expand to cover nearly everything a retail customer would normally pay for. You may start receiving invitations to educational seminars about investing, retirement planning, or estate basics, sometimes with actual advisors present, not just marketing materials. This is also the level where the bank starts cross-selling more aggressively, not necessarily out of predatory intent, but because you've become profitable enough to justify offering brokerage services, mortgage products, and insurance bundles, all coordinated under one relationship manager who benefits, both for you and for the bank, from consolidating your financial life under a single roof. Loan underwriting also starts to loosen. A slightly imperfect credit profile that would have been an automatic denial 2 levels ago might now get a human review and, sometimes, an approval. Crossing $250,000 often opens the door to private banking or wealth management divisions, a meaningfully different experience from standard retail banking in almost every way. At this level, you may be assigned a dedicated private banker and, in some cases, access to an investment advisor as a package deal, coordinated through the same institution. Loan terms improve, further mortgage rate discounts, higher credit limits, sometimes access to specialized lending products retail customers never see advertised anywhere, like securities-backed lines of credit. The physical experience changes too. Some banks offer private lounges, separate check-in at branches, and direct phone lines that connect to a human being who already knows your account history before you say a word. No re-explaining your situation to a new person every time you call. The bank is no longer just holding your money at this level. It's actively trying to become the single institution managing your entire financial life, checking, savings, credit, investments, and increasingly, insurance and estate basics too. $500,000 to $1 million is, for many banks, the doorway into their most serious wealth management tier, the last stop before high net worth status formally kicks in. At this level, dedicated relationship teams often replace single point of contact bankers, a private banker, an investment advisor, and sometimes a trust or estate specialist, coordinating together on your behalf rather than you juggling separate relationships across departments. Fees on managed accounts often start scaling down as a percentage, a quiet reward for larger balances that most retail customers never see reflected anywhere in their own statements. This is also the level where banks start proactively discussing things retail customers rarely hear about at all: tax-efficient investing strategies, the basics of estate planning, and sometimes early access to alternative investment products, private funds, structured notes previously reserved for institutional clients only. Something else changes here too. The bank starts treating you as someone with real optionality. You could plausibly move to a competitor, and the retention conversations, subtle as they are, begin. Crossing $1 million is a genuine inflection point. This is where most banks formally categorize you as a private wealth or high net worth client, with an entirely separate service infrastructure from retail banking, different phone numbers, different buildings in some cases, different everything. At this level, a dedicated team is standard, not exceptional. A private banker, a portfolio manager, and often access to specialists in tax strategy, philanthropy, and multi-generational estate planning, all under one coordinated relationship. Meetings often happen at your convenience, your office, your home, or a private space at the bank rather than you visiting a branch and taking a number. Loan underwriting changes fundamentally here too. Lending decisions increasingly factor in your total relationship and asset base, not just a credit score pulled from a standard bureau. You're no longer just a borrower being evaluated against a checklist, you're a client being retained, and the underwriting reflects that shift in posture. Between 2.5 and 5 million, the changes become less about new products and more about depth of access to the ones you already have. Portfolio management often becomes genuinely customized here rather than model-based, meaning your investments are built around your specific goals, tax situation, and risk tolerance, not slotted into a pre-built allocation used for hundreds of other clients at a lower tier. Fee structures frequently become negotiable for the first time, with basis point discounts available simply for asking or for consolidating more assets under one roof. This is also where access to alternative investments genuinely opens up private equity funds, hedge fund allocations, and structured products that were only mentioned in passing at the previous level become realistically available, often with minimum investment thresholds that exclude nearly everyone below this tier by design. The relationship also becomes more proactive in a specific way. The bank starts scheduling regular reviews rather than waiting for you to request them, because retaining a client at this level over a multi-decade relationship is enormously valuable to their business. Between 5 and 10 million, the relationship becomes genuinely bespoke, tailored specifically to your situation rather than fit into a pre-built tier at all. Many banks at this level offer access to concierge-style services, coordinating complex wire transfers across countries, structuring loans against investment portfolios instead of forcing you to liquidate assets and trigger a taxable event, and connecting clients with external specialists in law, tax, and real estate as part of an informal but powerful referral network the bank has built over years. This is also where the bank starts treating retention as an active, ongoing project rather than a passive hope. Relationship teams check in regularly, not just when a problem arises or a statement goes out. The bank understands that a client at this level has genuine, credible options to move their entire relationship elsewhere with a single phone call and behaves accordingly, often absorbing fees or offering better terms simply to avoid that outcome. Family dynamics start entering the conversation formally too, coordinating accounts across a spouse, children, or a family trust, sometimes with a single relationship manager overseeing the entire structure. At this level, you've reached a tier that exists at only a small number of institutions, and within those institutions, only a small fraction of clients ever occupy it. Many private banks here offer access to family office-style services, coordinated wealth planning across generations, direct access to senior bank executives rather than standard relationship managers, and highly customized lending arrangements that would never be offered or even mentioned to a retail customer under any circumstances. Fees, ironically, often become more negotiable here, not less. At this level, the size of your relationship gives you genuine leverage to ask for better terms, and banks frequently accommodate those requests, specifically to avoid losing a client whose departure would be felt across the branch, the region, or in some cases, the bank's internal performance metrics. This is also the level where the bank stops thinking of you as a customer in any traditional sense. You've become a relationship worth actively protecting, sometimes with services, discounts, and access that were never advertised anywhere publicly, because they were never meant to be publicly known in the first place. Philanthropy planning, cross-border wealth structuring, and access to pre-IPO investment opportunities are all realistically on the table here, in a way they simply aren't at any level below it. Here's the pattern underneath every single level in this video. The bank was never a neutral institution treating everyone the same way behind a friendly logo and a reassuring slogan. It was, from the very first dollar, a business quietly allocating its best people, its best rates, and its best opportunities toward the accounts that generate the most value and doing the opposite for the accounts that don't. The uncomfortable truth is that most of the premium treatment at the top isn't about better people working harder for wealthier clients out of some deeper sense of service. It's about the same institution deciding, level by level, dollar by dollar, exactly how much attention you've earned according to a formula you were never shown. And the fees at the bottom aren't an accident either. They're not a rounding error in an otherwise fair system. In many cases, they're a meaningful, deliberate part of the revenue model extracted disproportionately from the customers who can least afford to absorb them, while the customers who could most easily absorb a fee are the ones who almost never get charged one. Wherever you are on this staircase right now, know this: the products, the rates, and the relationships get better as you climb, which means understanding this hierarchy isn't just interesting to know. It's a roadmap for exactly what to ask for at every level, instead of quietly accepting whatever the bank decides to offer you first. Subscribe for more honest breakdowns of how money actually works, at every level, without the sugarcoating.